Welcome everyone, thanks for coming. So like Angela said, my name's Andy Davis. I am a local lender. So a little bit of background on myself. I went to the University of Florida, got my degree in economics, graduated with my master's degree in 2008. So I got out of college basically right at the absolute worst time to get into like the banking, real estate, any type of industry. So before that, when I was in college, I interned at Wachovia Bank, which ended up going belly up. I interned at a local bank here. And luckily enough, I was able to sign on and work for the local bank that I interned with in 2008, when basically no one could get a job in college. So I started working as a banker in 2008, and I did that for about 5 years. And pretty much what this community bank did was they started you from the bottom up. So I was a teller, I was a customer service representative. I went on and processed loans, and then I became a loan officer on the commercial side and the residential side, and basically figured out, because none of us really know what we want to do until we get way too old to change our minds. I was lucky enough to figure out that what I loved doing at a pretty young age, and that was doing residential loans. And so basically what I did, instead of like having to deal with the actual banking stuff, I went and got my mortgage loan originator's license. And I had a friend that was doing just loans, working for a lender actually in the middle of the state. And so I signed on and worked for that lender. And so that lasted about 3 months. So I think I was in like the 2012, 2013 time period when things were pretty good. Prices were still pretty low, but the market had picked back up. There was a lot of volume. There was good refinance volume. And so it was a good time to kind of go from 100% salary to 100% commission, except for the fact that I had like a 6 month old at home, and my wife had another on the way. But I was like, yeah, I had to get away from the bank. So did that, worked for a lender for 3 months, and then decided that working for a direct lender wasn't for me. And so I signed on with a local mortgage brokerage company that they're still open, and thank God for them. Never would say anything bad about them because they got me to where I am today. And then in 2015, so January 1st, 2015, like 6.5, 7 years ago, me, my brother, who some of you probably know, but his name's Dan Davis, and then Bob Bond, who's another like a high school friend of ours, opened up our company. And so we're a mortgage brokerage company. And basically the reason I opened that type of company is because, number one, our guidelines are basically pretty much set. And so like being an economics guy, I like to know, yes, no gray area. And so with us, there is that. And then the other thing is I always wanted to be my own boss. Like my goal coming out of college was to be my own boss by 40. And I'm 38 now, and I've been my own boss for 7 years. And so I'm sure that's probably why all of you guys got your real estate license too, because it's just way better to be your own boss, So that is my background. Derek is here. He's one of our loan officers. I think, how long have you been with us, Derek? Like 2 or 3 years now?
Almost 3 years.
3 years now, yeah. So he does all of our marketing and Facebook, and he got his mortgage loan originator's license because doing mortgage loans is so cool. And so he decided to do that too. He's like our young, hip guy. How old are you, Derek?
27.
27. So he keeps us like down with the times, So, all right. So understanding loans and how they work. So when I put this together, like Angela said, we had a request basically that real estate agents wanted to know how loans work, because pretty much, I'm assuming this, pretty much what happens these days, especially since COVID, is you are the only one that actually gets to see our customers, right? So you show them houses and all that stuff. They call me, they e-sign all the paperwork, and with closings, I think we're allowed to go to closings now. But with closings, the title company didn't want us to go to closings in person. So literally the only ones that would meet the customer is you, right? And so with that being said, you're the one that has to field all the questions from the customer. whether it's a title work question, a loan question, a survey question, insurance question, right? And so that's where the need for you to kind of know the baseline of how loans work came about. And I actually did I've had the request multiple times, but when Angela, Ned Hale actually, who's a local attorney, was the one that approached Angela, and he's basically like, hey, we've got to have this class. You know, we need to know how this process works. And so that's why we're here today. And I'm not gonna keep you all afternoon. I'm gonna be pretty straight and to the point. But if you have a question, basically we could probably fill up this whole time with questions if you want to. And that's gonna be the most important part of this presentation. I just put together a PowerPoint pretty much because if you don't have any questions, I want to have a baseline of what it is. But if you have questions about what I'm talking about, stop me or write it down and ask me at the end, because like I said, a bunch of this stuff is fairly detailed and we've probably all heard about it a little bit, but we don't know the details of it, all right? So starting out, the topics I'm going to cover today. So types of loans, credit scoring briefly, loan qualifying, and then the loan process, which pretty much is going to be covered throughout the whole thing, and then obviously questions anytime you want. So starting out, when it comes to types of loans for you as an agent, there's really two types of loans that are going to be offered to your customer. And the first is going to fall into the secondary market category, and the other is going to be what's considered like a portfolio loan, aka a bank loan, or just a loan where there's no secondary market activity that is involved. So basically what a portfolio loan is, it's the bank has all of our monies in deposit, and they lend out our deposits and make interest off the deposits that we give the bank, right? So how many of you seen the movie Big Short, The Big Short? A couple of you? So The Big Short explains it in pretty good layman's terms, the secondary market. Basically, the way the secondary market works is you've got a loan originator, they have the customer, closing happens, a lender lends their money up front for the closing, but then they sell the loan on the secondary market, get reimbursed for the money that they lent along with some fees, and then the secondary market, which is typically going to be Fannie Mae and Freddie Mac, they bundle up all those mortgages that meet Fannie Mae and Freddie Mac guidelines, and they sell them to investors. And basically what they were saying on The Big Short, and it's true, is until 2008, there was never really any defaults on home mortgages. So it was pretty much, other than the US Treasury bond, it was pretty much considered the second safest investment. And so the yields, which in turn are the interest rates on these mortgages, were pretty low because investors had that type of demand. And then in 2008, what ended up happening is everyone and their brother, sister, cousin bought a bunch of investment properties, drove the prices up, and then those mortgage-backed securities were a lot riskier, and it was the first time where people were actually like, all right, these things have some risk tied to them, and that's when the government came in and basically regulated the mortgage industry. All right, so let's talk about the secondary mortgage market. So the secondary mortgage market, you can see up there, it pretty much consists of the major, and so starting over, it's typically about 80% of loans go through this type of mortgage market. So banks sell their loans on secondary mortgage market. Lenders, so direct lenders, they sell their loan on the secondary mortgage market. Brokers, who basically have nothing to do with the actual money, they get money from lenders. But the lenders that they get their money from sell the loan on the secondary mortgage market also, okay? So in a perfect world for the financing companies would sell every loan on the secondary mortgage market, okay? And the reason is because it takes away their risk, all right? And so conventional loans, FHA loans, VA loans, USDA loans. So let's just talk about them for a second. So conventional loan is where there's no government insurance, no government guarantee. The government's basically not involved other than Fannie Mae or Freddie Mac. But basically a conventional loan, the borrower and the property meet Fannie Mae and Freddie Mac guidelines. And so once the lender originates the loan, they have the opportunity to sell that on the secondary market, all right? FHA is basically a government loan where the government offers the lender insurance in exchange for typically an FHA loan borrower. They're gonna have some type of deficiency to them, whether they don't have as big of a down payment, they might have a lower credit score, it might be all of the above. But typically, if someone's going to qualify for a conventional loan, they're going to use the conventional loan option. So with the FHA, the government insures the lender, and Fannie Mae actually makes the guidelines for the FHA loan option, and so that loan gets sold on the secondary market also. VA is when the government offers a guarantee, you put 0% down, yada, 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 loan gets sold on the secondary market. And the USDA is where there's an insurance and a guarantee, and that loan also gets sold on the secondary market. Long story short, what you as the real estate agent needs to know about secondary market loans is pretty much where the lender's getting their guidelines from. And so the lender's getting the guidelines on secondary market loans 100% of the time from the Fannie Mae selling guide or the Freddie Mac selling guide, okay? So basically what that is it's like a 1,200 page PDF sheet where the underwriters refer to. It's gonna determine whether the customer qualifies or not, all right? And if the customer can meet all the requirements of the Fannie Mae selling guide, then that loan's gonna be what's considered a good loan. Okay. Any questions so far? Yes?
What determines whether they use Freddie Mae or Freddie Mac or Fannie Mae?
That's a great question, actually. So Freddie Mac is typically an easier underwrite. And so, like me as a loan officer, if someone qualifies for Freddie Mac and they qualify for Fannie Mae, I'm going to choose Freddie Mac because Freddie Mac only requires 1 month's worth of bank statements, whereas Fannie Mae requires 2. Freddie Mac is a little bit easier on self-employed borrowers a lot of times. Sometimes Fannie Mae is easier on retired borrowers. So really the loan officer is going to determine that. The big thing right now that most lenders are determining it based off of is appraisal waivers, all right? Because appraisals are a pain in the butt. They're expensive now, like inflation hit appraisals tenfold, right? So they're super expensive. So if one of And basically there's a system that the lender plugs all the information into, and it spits out the approval and what you need. And so typically the lender's going to require, or they're going to choose Fannie Mae or Freddie Mac based on the documentation that's required to make it as easy on you and the customer as possible. So that's it. Now FHA, VA, and USDA are never going to be Freddie Mac. Freddie Mac only does conventional loans. Yeah. So, good question. All right. So, real quick, what I want to do, just so you can get an idea of what the selling guide looks like. So, and this is what myself and a bunch of other lenders are doing pretty much every single time you call and you say, hey, Andy, I got this customer and they just graduated from college. They've been on the job for 2 months, and half of their pay is commission. Can you do that loan, right? So off the top of my head, I'm going to need to know how much money they're making base. But basically, if I didn't know that, what I'm doing is I'm going to the Fannie Mae single family selling guide right there. You can see it's 1,241 pages, right? And so there's a bunch of junk, but this is where hitting Control F comes into play. And what I'm going to type in is, let's just say commission income. So commission income, and we've got, it pops up, you can see up there, I hope you can see up there, 18 times, right? And so I'm just gonna go down there to determine, all right, so how long does this borrower need commission income for? So what a lot of, and a lot of people think that 2 years, right? Raise your hand if you think someone needs income for 2 years in order to use it. A bunch of us, right? So why? Because that's been what's ingrained in our head. It was what was ingrained in my head also, okay? But it's actually not the case, all right? So with commission income, actually, Fannie Mae prefers 2 years, requires 1 year, and if there's mitigating factors in order for the underwriter to consider that commission income stable, then you can use the commission income even if it's only been received for 1 year. Now, if it's been received for 2 months, like my example, guess what? We're not using commission-based income. All right, we're going to be able to use base income because you have to have at least that 1 year. But again, these questions, it's all up here on the Fannie Mae selling guide. Okay, so if you're asking your loan officer or you're calling us and we say, I don't know, let me find out, this is typically going to be the first place that we ask. Now, a lot of these things in the Fannie Mae selling guide, there's a little bit of a gray area. So that's where there's now the option to get an underwriter to underwrite loans before you even take your borrower shopping. It's called a to be determined underwrite. And so in those situations, sometimes you have to be a little bit patient with your loan officer because the loan officer is going to need the documentation from your borrower first in order for an underwriter to actually underwrite the loan to determine if your borrower is going to qualify. Okay? All right. Questions? No? All right. How many of you are like, yeah, I don't really care about this? For real? Like, does anyone care about the secondary market or no? Not really? Maybe a little bit? All right, cool. All right, so I'll touch on portfolio loans real quick. I promise I'm going to get to what's going to matter to you guys in a little bit. I just wanted to kind of tell you how the market worked before we get into that, all right? So portfolio loans, which are primary market loans, like I said, what ends up happening with portfolio loans is the bank has a bunch of money and they want to make money on the money that we all give them. So they've got however many customers and they pay us a 0% interest rate, right? So their baseline money is 0. And so if they offer a borrower and they're 100% sure that borrower is going to pay them back, and they offer that borrower a 1% interest rate, how much money are they making on that loan? 1%. Why? Because they're paying all of us 0, right? And so portfolio loans, basically the most common portfolio loans that I mentioned up here are bridge loans, short-term loans, home equity lines of credit, adjustable rate loans, condo-tel, cross-collateralized loans. Basically, all of those loans are portfolio loans because those loans can't get sold on the secondary market, okay? And so what that means is that the bank decides 100% whether they are going to lend to that borrower. So guess how they decide that? Whether they think they're going to get paid back or not, all right? So if you're friends with the bank's CEO, then you're probably going to qualify for a portfolio loan. Like, no lie. Like, your best friends and the bank CEO has trusted you and known you for multiple years. You could go in there, sign the bottom of the application, and that bank CEO is going to lend you money because they trust that you're going to pay them back. And they're going to make money for the bank, right? So that's how these portfolio loans work, is the bank's going to gather whatever they need to meet their guidelines, which basically means they want to get paid back. On the secondary market, the bank or the lender or the broker is going to gather the documentation. So basically, whether it's a stack this big or a stack this big, the underwriter is going to gather the documentation that they need to present to the secondary market lender so that they can sell that loan. Okay? So that's the big difference between portfolio and secondary market. It's basically secondary market, every I has to be dotted and every T has to be crossed so the loan can get sold to the investor, whereas a portfolio loan, basically the bank has to determine whether you're going to pay them back or not. All right. And with that being said, though, the banks do have auditors. The banks do have regulators. And so, if for some reason you're the best friend of the CEO, but your debt-to-income ratio or your assets or your credit score is super low, well, then what's going to end up happening is they are going to have to do what's called a write-up. So it's the stuff that I used to do. It's why I quit doing banks. It's super boring. But basically, you have to do a write-up to explain to the auditors why the bank lent this person with deficient credit, low assets, low income money. And basically, it's like a 5-page report on how nice of a person that person is because they don't qualify financially. All right, so that's the difference between portfolio and secondary loans. All right, credit scoring. You guys ever seen this before right here? All right. So credit scoring, and we'll go over this pretty quickly. And the reason I like going over this pretty quickly is because credit scoring, you have no control over it. I have no control over it. Your customer has no control over it. Okay. So the 5 things, and let's start out with the things that they say count the most. Number 1, recent activity. All right. So it is a complete farce. It is not true that if you get your credit ran recently, it hurts your credit score. Okay? If you get your credit ran recently multiple times, so you go and you apply for a credit card here, and then the next day an auto loan, and then 2 more credit cards, that hurts your credit score. Okay? So if you have a customer and they say, yeah, I'm gonna call the lender, but I don't want them to run my credit because it's going to hurt my score, that is not true. Okay? The other thing is the credit scoring and reporting companies, they know the difference between a mortgage inquiry because they actually have to they came to our office, they had to make sure we had a shredder and all that stuff, but they certified us as a mortgage company. So when my company pulls a credit report, they know it's a mortgage company. So if we run a credit report, and then Wells Fargo Mortgage runs a credit report, and then another lender that is a mortgage company runs a credit report, that affects it. You can get 3 mortgage credit hard inquiries, and it affects the score nothing. Okay? So that is one thing that it's just one of those myths, and it is just that, a myth. Okay? So recent activity doesn't matter. Types of account, 10%. All right? So types of account, you're working with a buyer. How long do you guys typically like to work with a buyer? In 10 days, right? So like as little as possible, right? And so types of account, let's get real, you're looking to churn someone out in, I'd say probably 90 days, at most 6 months, right? So what is types of account going to do for any of you or me? Absolutely nothing. Because we don't want your customer going out and applying for a new credit card, a new auto loan, and a new boat loan to get their types of account that's 10% up, right? So types of account, don't worry about that either, okay? And then the last thing is length of credit history. So that's one thing that we all can kind of help our customers with if you need to. But the easiest way to get lengths of credit history is to be either good friends or have a parent that's super nice with someone that's older that has had a good credit history that's willing to add you onto their credit card as an authorized user. So like these credit repair companies, they work magic because they can get brand new people perfect credit in a couple months. The way they do that is they add them on existing credit cards or just credit in general as an authorized user for someone that's got like a 20-year history. And so let's just say I've got a Discover card that I've had for the last 20 years. And so when my kids, I got 2 daughters, they're 9 and 10. So they turn 18, right? And I like them at that point. I like them now. Hopefully I like them at that point. Who knows? But if I like them at that point, for the quickest thing I can do to get them perfect credit is add them to that Discover card. Now they've got 30 years worth of history, right? They're 18 years old.
So it doesn't matter if I do, like, if my kid's 8 as well. If I do it now or if I wait till she's 18, she's still getting my.
Well, you can do it now though, because you have to fill out an application. So per the application, I believe, and I think
But
you
I
have.
still get my full credit history.
They get you a full credit history at 18. Correct. So that's what I'm saying. Like literally, we will run someone's credit that's 25 years old. Because my dad actually did this for me. And so you'll run someone's credit that's 25 years old, and one of the cards will say that the card's been out there since 1990. Well, they were born that year, but it can't. Why? Because all this is an algorithm. Okay, it's a computer. And so the computer works on the positive side, the computer works on the negative side. Let me give you an example of a negative, all right? You go to the hospital because you drank too much Bang Energy one day and you think you're having a heart attack, right? And so you go to the hospital, you go to the emergency room, and this doctor sees you, this doctor sees you, this doctor sees you, and little do you know, the bills add up. So you have to pay the emergency room bill, and then this doctor's bill, and this doctor's bill, just because you drank 5 energy drinks, right? And there's nothing wrong with you. Well, if you don't pay those bills, or let's just say you pay all of them except $50 in medical collections, and they don't notify you, because this has happened to customers in the past too. You don't get notification, and then you call a lender and say, hey, I want to get my credit ran, and you basically have a couple things outstanding that you pay all the time, perfect credit history, but you've got a $50 collection that just got reported because of that emergency room visit. It's going to ruin your credit score. Okay? So again, the negatives, there's no way to fix that really, because if the medical collection company is going to report that on your credit, the credit algorithm is going to take that into effect and basically ruin the score, or at least lower the score by a lot of points if that's out there. Or if you're 25 years old, you've got a card that your parent added you to, it's going to affect you in a positive way, again, because it's a computer and it's not a person, right? And so the collection example, right? Let's talk about that for a second. If you have a medical collection or anything like that, what you can do and and if this happens to your customer, like they call and they say, yeah, the lender you gave me their card, and this lender sucks so bad because they told me that I had a 600 credit score. You're like, well, that's not their fault, that's your fault, right? And then, well, why? Well, I had a medical collection from something that I paid. Well, what your customer can do actually is call up the collection company and say, listen, I paid almost all my bill. I guess there's still this remaining balance. I want to pay you the remaining balance, but I need something in writing that you're going to totally remove this from my credit report. And the reason why is because if you pay a collection off, all right, basically what happens is that moves from collection to paid collection. You know what that does for your score? Nothing, okay? Because it still looks like you had a collection. So if you have a collection, what you need to do is make sure that collection gets removed from the report altogether. And then basically, let's just say you've got 3 items, perfect payment history, good balance. They remove that from credit. I've seen scores go from 650 to 800. It's just because that collection just totally goes away. Yes, ma'am?
So do you have to call like the credit?
No. So that is another myth too that a lot of people, so the credit reporting companies literally just report the information that they're given from the lenders. All right. So the collection agencies 100% control that. If you call the credit agency, because again, they're not going to remove it. The only ones that can get that removed are the collection agencies. You call the credit agency, basically what they're going to say is that you're disputing that. And the dispute can be an issue for lenders too, depending.
So who are you giving the stuff in writing to?
You're getting it in writing, but you're getting it from the collection company. And so basically, like if I ran your credit, you got a collection on there, I'm going to give you the phone number, and it's usually a local company. So like, because if you live here, you went to Lee Health, or you went to a local urgent care or something like that, they use local collection companies. Usually it's a 239 number almost every time. You call and say, hey, listen, I got this collection. I didn't know it was due. I want to pay you because I didn't know I owed it, so I want to pay you. but I need you to remove it from my credit because it's ruining my credit score. So I don't want you to just report it as a paid collection. I want you to remove it altogether, and they typically will. Yes. Yeah. So what can we do to help credit scoring as agents or as mortgage people? Typically, credit usage is the one thing we can do. All right. So if you've got customers and they, for some reason, you think their credit cards might be maxed out, what I'm talking about here is balance to limit ratio. Okay. So if you've got a $10,000 limit and you have a $10,000 balance, and that's the only thing you have, that 30% of your score, that's going to hurt really bad. Okay, so paying down credit is the quickest thing we can do for our customers to help them get their score up. And the second thing is make sure they pay things on time. So some people just forget to pay their stuff. Those people should probably put their accounts on auto payment. But if they don't have it on auto payment, you want them to pay things on time, because the longer a late is on a credit report, the less it affects their score. So if you have a late credit card that was 2 years ago, and I have a late credit card that was 1 month ago, my late credit card payment is going to be a lot worse than yours, because basically what this algorithm thinks is, this guy didn't pay his last credit card. Is he going to be able to pay for his next credit card payment too? Right? So those are the two things we can kind of do to help people with their credit scoring.
Question.
Any question? Yes.
Is it better to carry a balance and pay it on time, or pay off in full every month?
Pay off in full every month. And paying off in full every month is gonna be better for you to sleep at night too. You know, you guys have probably all heard of Dave Ramsey. Dave Ramsey's like, cut the car. Like, I'm not cutting my cars because I get 1% back, so I'm paying everything on credit card.
Yeah.
But if you pay, but what most people do with cars, and this is what's happened to me since I had kids, because you spend a lot more money when you have kids, is so I thought that, because every statement that comes out, I pay the statement in full, right? So I'm like, so that should make my balance zero. No, all right? So you have rolling statement balances, which means the statement date comes on this date, like let's just say the 15th, but your payment's due on the 1st, so it auto pays that statement that cut off the 15th on the 1st. Well, there's 15 days that you've been using your card, so your balance isn't zero anymore. So if you have like a vacation month, after you paid that down to zero, sometimes your balance will actually be above. And so the ratio that credit scoring companies like, and you write this down, is 15%. So like they want it to be 10 to 15% in a perfect world. 30% usage ratio is okay. And anytime someone gets above 50%, it really starts hitting their credit score kind of hard. And this is on every single card. So let's say you've got 4 cards. One's got a $10,000 limit, you got $2,000 balance. One's got a $5,000 limit, you got a $1,000 balance. And then you have a $300 limit because you signed up for a JCPenney card, and that's got a $300 balance. That's going to hurt your credit because it's a 100% usage ratio. And so, again, the algorithms don't think. There's no common sense here. It's just a computer. Okay? Any other questions on credit scoring?
So the usage is not the total balance,
Usage is the total. It is based on the total balance.
but is it per account though or not?
Oh, no, excuse me. It's not. No, you're right. I thought you were talking about the one specific account. No, yes, it is per account.
Okay.
The usage is per account. So literally, if you've got 2 credit cards, right, and one of them has a 70% usage ratio and the other one has a 10% usage ratio, if you take a cash advance from the 10% and you pay the 70% down to 30% and the 10% goes up to 30%, your credit score is going to go up. Yeah, so it's not a global thing, it's based on each item. Yeah. Yes, ma'am?
So what happens if, say somebody has a credit card with a,
$10,000 balance on it. And then they get a new credit card that says balance transfers for 15 months at 0%. So they get this new credit card to pay off that one, and then so they have it on there with no interest. What does that do?
So it depends on what the limit on that one is. It really truly does, because so you got a $10,000 balance on this one right here. Let's just say the limit on that one's $20,000. Well, you're at a 50% usage ratio. If the limit on the new one's $10,000 and you put $10,000 on that one, now you're at 100%, credit's gonna drop. Yeah, but if the new one has a $30,000 limit, you pay this one down to 0, so now you're at 0%, and this one's at 33%, your credit's gonna go up.
Oh, okay.
Yeah.
So the new one has a higher.
It's all about balance divided by limit. It's all about the percentage. So yeah, if you want to write that down, that is, and again, that's something that you can tell your customers too, because it's that simple. And just for them to get prepared, typically credit reports are reported every 30 days. So if you're working with someone, they say, yeah, I want to buy within the next 3 months. That's something to mention. It's something that we would mention. It's something that most loan officers would mention if their scores, if they need an improved score. A lot of people, honestly, most people, if they've got good payment history, none of the other things count. So it says 35%. That's more like typically about 70%. Yeah, so like if you've got 100% balances, but you've had good payment history for the last 5 years, you're still probably going to have over a 700 credit score. Yeah. Did I see someone else with their hand up? Yes, okay.
So you were saying if you had a late payment last month, it's going to hit harder than a late payment 2 years ago.
Correct.
Is there a ratio where that 2 year ago payment falls off after 3 or 4 or 5 years?
I think 7 is what they say, but I've never really researched into that.
But the longer it goes, the less it affects the
Correct. Yeah. I mean, you'll have people that legitimately have a perfect credit score is 850. So I've never seen that before. But you'll have customers with 830 credit scores that have late payments. Like they're almost perfect, but that late payment was 5 years ago. It literally affects their credit right now by nothing. You know. So, but I do think
Something like that, typically it's just gonna be like a mistake.
it's a one-time mistake.
Yeah,
Exactly. So you got 20 credit cards that you paid down off, but you forgot to pay this one time. It's a one-time mistake. They count that in. So yes, ma'am.
I might have a dumb question. I thought medical bills weren't like hurting your credit.
Yes, so did everyone else. That's why I mentioned that.
If they're in collections.
Yes. All right. So medical.
Is it only if they're in collections?
Well, it's always a collection for medical bills. So if it's reporting on your credit, it's reporting as a collection, no matter what. So here's what, and this is where the media. So the media, they are correct in saying that a lender will not deny you a loan because of a medical collection. So like if someone has a 640 credit score and that's a qualifying credit score and they've got a medical collection, the lender's not going to want to see any additional information for that medical collection. They just say, oh, it's because it says mortgage, revolving, auto. It'll say medical. If it says medical, no questions asked. I'm not going to need a letter of explanation or anything, right? But that doesn't mean that 640 credit score could have been 760 because of that. So they're taking now. I have heard, and I think they probably will because they've actually been doing some common sense things with credit scoring recently, which is awesome for all of us. I have heard that they're going to start taking that out of the scoring equation. But so medical is still in the scoring equation, but it's not considered when underwriting the loan. Okay? But the scoring equation is the number 1, 2, and 3 things that affects interest rate.
Yeah.
Okay? So like typically a 740 and above, you qualify for the best interest rate. Every 20 points below thereafter, it drops down by specific basis points. So someone with a 640 because of a $50 medical collection that would have a 760 legitimately would be paying the equivalent of about $5,000 to $10,000 more in origination points on their loan because of that $50 medical collection. So like it is that crazy the way this works, but it just is the way it works. Any other questions on credit scoring? All right, cool. Moving right along to loan qualifying. All right. So loan qualifying. So the rest of my presentation is going to be based on the secondary market underwriting because, again, like I was telling you on the portfolio loans and the primary market underwriting, that is bank specific, so they're going to have different guidelines for everyone. So all of this stuff is going to be based on Fannie Mae and Freddie Mac requirements. Okay? So basically, Fannie Mae has an underwriting system that's called Desktop Underwriter, also known as DU. Okay? So write down the letters DU next to that slide. Okay? Freddie Mac has an automated underwriting system and it's called Loan Prospector. And so write down the letters LP next to that slide. So basically what DU and LP do is it tells us as the loan officer the documentation that we're going to need in order for your borrower to qualify. Okay? And it also tells us for sure whether the customer is going to qualify or not. So basically, if your customer calls the loan officer takes a full application, the loan officer is confident that everything that the borrower says over that application is going to be true and can match up. Basically, what they can do is run what's called the DU or LP to determine if that borrower qualifies or not. Okay? So the three main parts of that automated underwriting system is credit score, and credit score is just a number. Okay? So the lenders use the middle score, and the lenders use the middle score because the DU and the LP use that score. Okay? So credit score we can't really do anything on, but it's again the main factor in pricing. The second thing is sufficient assets. All right? So sufficient assets basically just means that the borrower / any type of contributions like seller paid contributions, gift contributions, or anything like that meets the Fannie Mae or Freddie Mac guidelines. Okay? So basically what the loan officer can do is if, let's just say there's a $100,000 purchase price, the borrower is applying for a 3% down conventional loan, that's a $3,000 deposit from the borrower. And if the lender thinks the seller is going to be willing to pay for the borrower's closing costs, they can put that in there. So you can literally run through the automated underwriting system. Someone has $3,000 in their bank account, a 3% down, $100,000 purchase price, and it'll spit out whether they're going to approve with just $3,000 if they can get the contributions made up or not. Okay? So that's how important these automated underwriting systems are. How does that help you out? It helps you out because I know you probably have specific lenders that you refer to, but on your listings, and we all know that what's the saying, listers or last, or everyone does listings, right? If you get a listing, hey, I want to list my, oh yeah, I only work with buyers, I'm not going to take that listing, that's not going to happen. Okay. Right? If so, good for you. Like, and if so, give me your card after that. No, just kidding. But so it helps you as the listing agent though, because you can't control who the other sales agent buyer is working with, right? But what you can do is you can call them. Okay? So whether it's a pre-qualification, a pre-approval, a business card that in handwriting of a loan officer says this person's it doesn't matter. Okay? If you have a pre-approval letter, a pre-qualification, the letter doesn't matter. Okay? It doesn't matter what it's called. All right? It can be a blank sheet of paper, for God's sake. There is nothing that ties a lender to lending money for issuing a pre-approval, pre-qualification letter, or anything. It's as good as the paper it's printed on. All right? So And the reason I say that is because these lenders, especially the online ones, you can fill in whatever information you want to as the borrower. They're going to run a credit report, but all they actually verify is the credit report, and they issue a pre-approval letter. Okay? So what do you do to protect your listing? You call. Okay? So call the lender. If you can't get a hold of that lender, then it might be a decent idea for you to tell the salesperson that's representing that buyer, hey, listen, I can't get a hold of their lender. Can you call the lender and have them call me? Can you have your customer call the lender? My seller probably is not going to accept this offer if we're not able to get a hold of the lender. Okay? And that's totally fine for you. Okay? It's up to your seller ultimately, whether they want to accept the offer or not. But you can tell them not to, right? That's within your duties, but you can advise them on whatever you want. You don't have to. But the reason you want to contact that lender is because if you can't get in contact with that lender within a couple of days, think what's going to happen throughout the process. Are you going to know when the appraiser is going to come? Are you going to know that insurance has been down? Title work has been down? The process is going to suck. So the number one thing you can do is call the lender. Now, the next thing you do is you say, hey, I want to make sure that you talked to this borrower. Because an online application is an online application, but again, borrowers don't know the difference between different incomes. I'm going to talk about the different types of income here in a second, but they don't know the difference between different incomes. They just plug in their income. Base pay to a borrower, if they're 100% commission, well, they think that their 100% commission is base pay because that's the base of their pay, right? They don't know that lenders have to put that in the commission line, okay? So make sure that they talk to the borrower, all right? Number two, ask them if they ran into DU or LP, and that's why I told you to write it down, okay? Now, if you ask them that, they will know that you know what you're talking about, and they're going to tell you yes, okay? Even if they didn't, because I would tell you yes even if I didn't. But if I tell you that I ran into DU or LP, and I tell you yes and I didn't, guess what I'm probably going to do like 30 seconds later? I'm going to run the DU or LP. Just because this person's got a perfect credit score, they're putting 30% down. But I want to make sure, because I just lied to that agent, I want to make sure that and it always runs, right? But if you ask them that, then they're going to know. Because again, so many, especially this day and age, after COVID, everything became electronic and automated. And what ended up happening is so many deals end up falling out because of that. So communication really is the key, okay? And then, so sufficient assets, I think I got out on a tangent. And then debt to income ratio. So debt to income ratio, again, there's different debt to income ratios. For an FHA loan, the debt to income ratio can go all the way up to 57%. Does that mean that every person that has a debt to income ratio with the qualifying credit score and qualifying assets will get approved up to that? No. What do? You run it through the automated underwriting. VA. I just financed a VA loan that closed a couple of weeks ago, and that veteran's debt to income ratio was 70%. Super high, all right? But VA actually bases qualifying off something different, which is called residual income, and the veteran had plenty of residual income. How did I know the veteran had plenty of residual income? I ran it through the automated underwriting system, and it told me. Okay? So those are the three main things the automated underwriting system's gonna tell us. Any questions on that? No. The one other thing I'll mention on loan qualifying is lenders never base qualifying off the asset, even on portfolio loans. The key is what's called the term that they came out with in 2008, the ability to repay. And so the asset's not paying anyone back. All right, so the asset might be worth $1 million and the loan's only $200,000, but the auditors in the secondary market, they are not considering that loan to value when they're approving a loan or not. Okay, because again, the asset doesn't provide the ability to repay unless the asset is going to provide rental income, which then provides the ability to repay, which we'll talk about here in a second. All right, so next slide is income requirements. Oh, we're doing good on time. All right, sweet. So income requirements. So basically, I just put up the kind of the most common / main income. I literally cut and copied this terminology from the Fannie Mae selling guide because they have specific paragraphs and subparagraphs. So we'll cover the first, number one, employment and other sources of income first. And so this is going to be usually about 80 to 90% of your clients is their income is going to be based off of employment, commission, secondary employment, or rental income. Basically, when it comes to that type of income, there's two real requirements. The first requirement is that they have to have a 2-year history. So if you want to write that down as a note, 2-year history, that includes schooling. Okay? It doesn't include high school, but it includes any schooling thereafter. So if someone's in high school and they dual enrolled and they got their AA degree and they can produce 2 years worth of transcripts from the college, that would be included also. Okay? So a 2-year work history, and then for base pay, the lender wants to see 30 days worth of pay stubs. So you can literally, the example I'll use is the person that gets a job right out of college, they start work, they can close on their first house as soon as the lender gets 30 days worth of pay stubs. And in some instances, if there's an offer letter from the employer, the offer letter accompanied by one pay stub would satisfy that. Okay? So again, we need 2 years worth of history, including schooling, but 2 years at the same employer, farce. It's never been that way. Okay? 2 years in the same line of work. Sometimes, okay? It really depends. But again, that's one of those things where that's going to be underwriter discretion. If an administrative assistant to someone at the school district moves over to be the marketing coordinator to someone at a real estate office, is that the same line of work? No. Are they going to qualify for the loan based off 2 years of employment at the school district? Yes. Okay? So the underwriters are looking for any reason to approve these things. All right? So that's the base income, regular salary employment income. Bonus and overtime. Lenders looking for 2 years worth of bonus and overtime, and they're trying to make sure that the bonus and overtime is consistent and trending upward. If bonus and overtime are trending downward, most of the time they won't be considered. Okay? Commission. Same thing, so they prefer 2 years, they need 1 year, but commission income needs to be trending upward or at the same amount. If commission income is trending downward, so like for example, I'm a mortgage loan originator, I killed it last year on refinances. Refinances suck now, I probably wouldn't qualify for a loan right now, no lie. So if my income drops from year A to year B, and the underwriter's like, holy cow, there's a huge drop. You can write a letter of explanation. Maybe they would qualify. I don't know if they would or not. But the person walking down the street, if their income drops by a specific percentage amount, most of the time they won't qualify, even if their new income qualifies. Okay? Because for some reason, Fannie Mae and Freddie Mac don't like seeing this, they like seeing this or this. And it all stems from 2008, right? So mortgage loan originated in 2008 were making $1 million. The next year they made like negative 5,000 because they had to pay for a bunch of things. So that's when they got so conservative. All right, self-employment income. So the only thing I'll tell you about self-employment income, because we're not going to delve into details on that, is is that the lenders are looking at self-employment income globally. What that means is, if you own a corporation and your corporation makes $1 million and you pay yourself personally $0, guess how much you made as far as net to the lender? You made $1 million. Okay? So, because they get it. Alright? So they get the fact that if you pay, and realistically, if you're the owner of a corporation and you're making $1 million, you probably should pay yourself some type of salary, or else the IRS is going to audit you pretty quickly, I would say. But again, if you pay yourself, let's just say $100,000 salary, and then the net income is $900,000 because you paid yourself. What the lenders are doing is they're taking the $100,000, they're adding the $900,000, and that's the income that they use. Okay? So businesses, because a lot of people are like, yeah, I don't pay myself anything, I can't qualify for a loan. Well, if your business makes a lot of money, it doesn't matter whether you pay yourself or not. Okay? Any questions on that? All right, cool. All right, so here's where, if you were not paying attention or bored or whatever, this is what actually affects you guys. All right, so you should have gotten this folder right here. So we came up with some decent new, we think it's decent new marketing stuff. So on this, in here, we've got this buyer's agent's checklist. So if you can, and we just branded it as a buyer's agent checklist, this is a listing agent checklist too, okay? And the reason it's an everything agent checklist, it doesn't matter who gets this documentation. If you gather this stuff up front, it's gonna see the process, okay? So on the board, I've got, so for single family, the checklist is gonna be a little bit different, but let's just say you win a listing, you get that listing, right? So if you're going to accept finance offers on that property, you can go above and beyond to try to get that deal to close sooner, smoother, or all of the above. And so those are basically the three main things that you can do in order for that to happen, okay? So the first is homeowner's insurance. So the minute you get a new listing, send out that new listing for a homeowner's insurance quote, okay? There's a ton of affiliate members here that are insurance agents. It's like lenders, title agents, and insurance agents, right? Choose your favorite one and ask them for a quote for your new listing, okay? And the reason I say that is because whenever the buyer's agent shows that property, having that quote sitting on there is useful. It's going to be useful for their buyer, right? So get a quote. If that quote looks high to you, okay? So you get a quote and you're like, man, $5,000, I don't like that quote, right? And that seems to be a lot of quotes recently in homeowners and flood. Well, if the quote looks high, it may be because they based it on not having a wind mitigation inspection or not having like super clean inspections. So give them a call and say, hey, how do we get this quote down, right? And then the third option would be ask your seller, hey, how much do you pay in insurance? So if you get an insurance quote from insurance company A and your seller's paying half that, might be a decent idea to get a quote from your seller's insurance company also, okay? So the reason I say get a quote as a listing agent is because this is going to be a requirement for anyone unless they're a cash buyer, okay? If they're a cash buyer and you got an insurance quote, guess what? You wasted a little bit of your time. Who cares, right? So that's what we're here for, is all we basically do is send out and quote unquote waste our time until we close. That's when we get paid. Well, this is going to help the majority of the deals close, so get the quote, right? Flood insurance, second thing, all right? So flood insurance, you guys know how to determine whether a property is in a flood zone or not? Yes, no? All right. So if you don't, all you have to do is go on Google and write down and type in FEMA flood zone map. Click on that, put in the address. Properties that require flood insurance are all properties that are not in flood zone X, okay? So So if you didn't know that, write down flood zone X, no flood insurance. If the property requires flood insurance, that's where the work kind of starts, all right? So flood insurance, and I'm not an insurance guy, but I feel like I am these days. All right? I mean, you probably feel the same way, right? Insurance is just so tough. Right, I actually feel bad for the insurance agents these days. I think there's like 2 or 3 insurance underwriters that went belly up because they were in the state of Florida. It all stems from all the roof claims, I guess, is what they say. And the statute of limitations is 5 years. So if you have a hurricane in 2017, but the roof was like super old and now it's leaking 5 years later, you can blame that on hurricane or not. I don't know, I'm just saying. But anyway, so now everyone's insurance policies went up because of all these insurance claims, right? Well, flood, what happened last year with flood is they redid the flood map and to the negative for the consumer also. A lot of flood insurance quotes have doubled, tripled, and such. So 3 workarounds for flood insurance. Well, not workarounds, but the first thing you do for flood insurance is the same thing. If the house, you request an insurance quote, say, hey, this is in a flood zone, can you give me an idea what flood's gonna be also? Okay? If they type back and they say, I don't know what flood's gonna be, I'm gonna need an elevation certificate, then you ask for the elevation certificate, which would be part of the survey. Okay? So see if your seller has one, send that to the insurance agent and say, here's an elevation certificate, can you base it off this elevation certificate? Okay? With that being said, it still may be pretty high, and so the third and kind of final step is a lot of buyers are assuming the seller's flood insurance policies now, which is a really kind of a nice benefit for the next year. When it renews next year, it's probably going to go up after that. But basically, if a buyer assumes the seller's flood insurance policy, nothing changes. So the buyer doesn't get any type of, or the seller, excuse me, doesn't get any type of refund. So if they've been paying on that policy and it expires 3 months, they pay 9 months, they're not getting the next 3 months of a refund. If it just started a month ago and there's 11 months to go and they paid in full, they're not getting that 11 months worth of refund. But basically, if the seller flood insurance gets assumed by the buyer, just everything stays the same except the buyer's name is on it. Lender will accept that. A lot of times it saves the buyer thousands of dollars because they assume the seller's flood insurance. So these are the 3 main things you can do on your listing to help go smoother, or if you've got buyers, that also helps it go smoother. Any questions on these? No? Anyone do this already? Yeah? All right, cool. All right, so the next thing I've got is the condo checklist. And so the condo checklist is a little bit different. So in one of the sheets that you guys have is the Form 1076. It's a Fannie Mae condo questionnaire. Anyone ever seen one of these before today? No? A lot of people probably haven't, right? That's why I printed them out. So the Fannie Mae Form 1076 is basically the form that every single lender is using to determine whether the property is going to qualify for a secondary market loan. So the first thing on a condo listing for you to do as a listing agent is know which places offer portfolio loans on that condo. Okay? Because a lot of condos that used to qualify don't qualify because of the new Fannie Mae condo questionnaire, which we'll cover here in a second. Okay? So just no portfolio loan lender that will lend on non-qualifying condos, basically. And again, there's affiliate members that will be willing to do that. So that's number 1. Number 2, get in touch with the condo management company ASAP. Okay? So the minute you get the listing, get someone's contact information from the management company and get someone that is super responsive. Heck, for that matter, you can even send this to them and say, hey, do you mind filling this out? Get it filled out and then send it to me. I'll tell you whether there's going to be issues with the condo or not. Okay? that condo association manager, whether they're good, whether they stink, or they're going to be a part of your team during that process. So getting a hold of them right up front is gonna help out a lot, okay? So on Form 1076, it's pretty standard stuff. A couple things that I will highlight about this is, there's a question on here, is there any ongoing litigation? So it's on page 3, so this is front and back on page 3. It says, is the HOA involved in any active or pending litigation? Number one, an insurance claim on a roof is not litigation, okay? So some condo management companies have to be told that, okay? That's not litigation, that's just an insurance claim, okay? If it's an insurance claim, the insurance company denies the claim, and there's a lawsuit, then it's pending litigation, okay? If there's pending litigation, that does not mean that the condo automatically doesn't qualify. It basically just means that you're gonna have to get meeting minutes, you're gonna have to get proof that that condo is fine, that it's not deferred maintenance, that anything that the pending litigation is based on has been repaired, and prove that. So litigation is not a deal killer. Litigation is a deal killer with a management company that won't provide the lender with information. Okay? And then keep turning to page 6. It should say condominium project questionnaire addendum. Anyone hear about the condo in Miami that collapsed? So the condo in Miami that collapsed changed condo lending for basically probably ever. That one condo collapsed. Now we've got this condominium project questionnaire where the management company has to give the lender their opinion on the maintenance of the building, was there any deferred maintenance, yada, yada, yada. So this right here, it's a little bit newer. It started at the beginning of this year, maybe the end of last year. But management companies are having a lot of issues with this because they say it's not within their scope and that the lender should hire an inspector or something like that. The lender needs this to get answered in order to finance the condo. It's just the bottom line, okay? So, and that's why I printed these out for you, because when I first started, condos were a huge issue because there was a bunch of foreclosures, their budget wasn't good, yada, yada, yada. Condo financing got super easy up until this little addendum. So about 95% of condos were getting approved then. Since this addendum, I'd say, and again, condos are still getting approved because most condos right now in a market like this are super solid. They got a good budget, they are taken care of, people aren't late on their dues and all that stuff. But if a management company feels like they can't answer these questions right here, then basically the lender's going to need proof that there's not deferred maintenance in the form of, again, meeting minutes, or just someone that is willing to put their signature on this. It could be an association president, it could be a treasurer, anyone involved with the association. But again, so that's why contacting the management company and making sure they'll fill this out is really gonna be the main thing on their listings to get prepared. Yes, ma'am?
Is that multiple stories, or we have a lot of townhomes or single stories or fourplexes that are HOAs? Do they require this also?
No. HOAs are the best thing to ever happen to lending, and condos are the worst. Yeah. So basically, like the four single family attached things, on what you can do is everyone sells the county primarily, right? So on LIPA.org, there will be on the front page, it'll say classification, and classification, it'll either say single family or it'll say condo. So a lot of townhomes are considered condos because they're located in a condo association, so they are condos. The other place you can look is legal description. So on the legal description on LIPA, it'll say phase something, that's a condo. It'll say lot something, and that's a single family. The single family HOAs is totally fine, okay? But again, this is just something to keep around and know if you're listing a condo, if you got buyers that are looking at condos, and they're financing, this is gonna have to get answered one way or the other. Yes?
What does it have to do, if someone's financing a condo purchase and if the owner occupancy versus how many renters are in there?
It depends on the use of the person that's gonna be purchasing that property. So if they're gonna use it as their primary residence or their second home, it has zero effect on qualification.
Oh, okay.
If they're gonna be renting it out, then it has to be less than 50%. Yeah,
But they're paying to live in full time.
if they're gonna live in it, it's not even a question, and that's another myth. There's just so many myths that
Well, that just came up in a situation last week with looking, showing a condo, and other agents like, we need to find out how many people are renting.
Sometimes the HOA controls that too, they don't want more than 50% rentals or whatever.
Yeah, that is sometimes an HOA question for sure, but lenders don't care if it's a primary residence or a secondary or vacation home. So if your customer is gonna be living in it or living in it as their vacation home, the lender doesn't care if every other condo in the complex is rented out. Like, it
So
can
if
be,
they're gonna use it as a rental property?
if they're using it as a rental property, then basically the lender's trying to make sure that the whole condo complex is full of investment properties.
Okay.
Because investment properties have the worst performance in the past, and so obviously they're more risky, so they have additional requirements, the lenders have additional requirements. Any other questions? Really good questions. All right, so that's our condo checklist. This is just a timeline. We got a timeline in your folder too, but this is basically just a timeline. The only thing I'll say as far as the loan process is, and your lender might get annoyed with you. I'll admit sometimes if like your follow-up day is Friday and it's been a long week, I'll get annoyed with you too. Follow up with me anyway, all right? So the key to the loan process is communication, all right? And so my recommendation is talk to your lender, whether it's your lender, whether it's Rocket Mortgage, whether it's Suncoast Credit Union, whether it's Wells Fargo Bank, I don't care about the lender. Talk to the loan officer at least once a week, okay? So throughout this whole process, from pre-qualification all the way to the end, other than maybe the pre-qualification, because if they're not finding any houses, there's no, hey, I took so-and-so to look at houses, they still haven't found, it's like, well, yeah, you didn't really tell me that. But once they get under contract, just have a day. I don't know what day. For some reason, for me, because I've got a follow-up day too when I'm working on a deal and the contract's executed. I got a follow-up day with the appraiser, with the appraisal management company, with the title company, anyone, the insurance company, anyone you're working with. Just have a follow-up day. But with the lender, communicate with them weekly, even if it's just an email. Hey, just making sure everything looks good, or haven't heard from the appraiser. The lender needs to know that stuff. So if you haven't heard from an appraiser and the lender told you that the appraisal was ordered 5 days ago, the lender has no clue. Like, we order the appraisal, they contact you, we're out of it because the management company is the ones that do the appraisal assigning. Contact your lender and say, hey, I haven't heard from an appraiser. Can you double check? Because again, you can't double check with the AMC because you don't even know who it is. We can't double check with the appraiser because we don't even know who that is. And so contact us, we'll follow up with the AMC, who then contacts the appraiser. Okay? And that's pretty much it as far as the loan process. It's communicate, and that's all I got for you guys. So any questions at all, or examples or scenarios that you want to run over?
You'll have to add a comment slide to your presentation, yeah.
Oh, yeah, I know. It's so tough to come up with all of them off the cuff. So, yes.
It's not really a question, but that's what I meant earlier when I said things change. Because isn't it for the condos, if one person owns, I remember this years ago from I was reported this, if one person owns a certain percentage in that.
That is a requirement. So yeah, and that's on here too. So if one owner owns more than 10% of all the condos, then they won't, the Fannie Mae Freddie Mac won't finance that either. So again, I mean, and like I
That was
said,
like the cusp.
per-
That, I remember that deal.
Exactly.
And it was that one person, I'm pretty sure he still does own it.
yes, yeah. So, and that's where, like, realistically, it is good to have a good relationship with multiple lenders. And the reason is because if one lender was the best at portfolio loans, secondary market loans, and all that stuff, they'd be so busy that they would go nuts. Like, there's just, it's impossible to be the best at everything. So it's good to probably have two, I'd say at least two, one secondary market, one portfolio lender, and then trust them so that if one of them says, yeah, this probably isn't my cup of tea, then they're gonna tell you who might be able to do it, you know? Because it's just, it's one of those things where, like, if you're selling a property in LaBelle, and maybe LaBelle is a USDA heavy area, and you typically sell properties on Sanibel, and you use portfolio lenders because Sundial, which is a condotel, is your farm, and you sell, well, guess what? Your portfolio lender probably isn't gonna know how to do a USDA loan in LaBelle, you know? So it's just good to have multiple options in regards to that. Yes, ma'am.
So the portfolio lenders is like a local bank.
Yes,
That you go to get a home loan.
correct. Yeah,
And they just keep it the whole time, they don't ever.
exactly. They don't
It's
sell.
harder to get than the other one?
They all, yeah. So local banks have a little bit more stringent requirements on the customer because again, they're lending on properties that can't be sold on the secondary market. So they want to make sure they're getting repaid because if they have to end up foreclosing on that property, they know that when they have a bank REO, that property is not going to be as marketable because you can't get a loan on the secondary market. 80% of all loans are on the secondary market. So they want to make sure, but like the local banks that offer these portfolio products, their underwriting is basically going to be the same as the secondary market. Like they've got, when I worked at the bank that I worked at, and we did portfolio loans, you basically, it's like the Fannie Mae or Freddie Mac approval. You open this sheet up, and you say, all right, this is what I need to qualify, and that's that. So I mean, so Sanibel Captiva Community Bank, which I don't even know if they're an affiliate or not, but I know some people that work over there. And they actually said, because they do secondary market lending too, almost every bank does secondary market lending too. Last year, 70% of their loans were secondary market lending, so originated and sold in the secondary market. This year, 90% of them are portfolio loans, and only 10% are secondary market lending. So like they're taking advantage because they can offer an adjustable rate mortgage at a lower rate. Secondary market doesn't, you know? So again, it's just, things are constantly changing in the loan industry. And so again, it's just good to have a couple different options out there. So. All right.
These are very nice.
Oh, awesome. You're welcome. Cool.
Today?
What?
Extra here?
Yes.
Yeah.
Yes. So, you guys good? All right. Enjoy your pizza.
Thank you.
All right.
Thank you.